You want to say anything to anybody?
Hello.
Hello.
Peace. Hello, everybody. So today is Tuesday, October 14th, 2025. And I've mentioned this before, but I'll mention it again regarding a good trade. You know, these are very, very dangerous times to put on trades because there are so many extended tickers out there that with all the euphoria out there, it is possible that prices could go higher and prices could fall 50% in a week. My thesis was that the market would not have a serious correction until the end of October or into the first week of November. And it was just a guesstimate based on, it was so strong. I just, you know, September and October are typically the 2 months of the year that typically see corrections. And when September, you know, that was my thesis all along. And then when September was very strong. And I said, yeah, I mean, it's like slowing a freight train with all the euphoria. I started thinking it might not even slow down the first half of October. It might not go backwards until the end of October. And we're not talking backwards, you know, I'm talking something that, you know, is down for a week or two, not something that's down a day or two and then bounces back up. And we haven't seen that. We've seen a couple blips based on Trump tweets. But other than that, if Trump had said nothing this year, who knows how high the markets would be. Although he's pumped them as well. So one trade that I think is a very good trade with limited risk is UNG, which is natural gas. And on my chart, the way I've been tracking it, I have a couple of support and resistant lines, and it wasn't a channel, a downward channel earlier this year, and it broke out. And after it broke out, it fell back down, and it's been chopping up, down, trying to break out, break down. And this morning, a lot of people thought it broke out last week when it went up over $13, $14. And I didn't think it, you always have to wait for a confirmation. It didn't confirm the next day, it broke down. And it headed right back in the last 3-4 trading days, it's headed back down to the support line. And the support lines, you know, it's never to the exact penny. It could be, but usually markets will do what they want to do. So off the top of my head, I think I have support at either 1163 or 1173. And it got down there today. And so one of two things is going to happen, right? Because it's bounced off the support line several times. So one of these times, it's going to bounce like a trampoline and go higher, or it's going to break through and go significantly lower. And the way I look at it is what I'll do is I'm doing two different kinds of trades with two different expirations. And of course my thesis could be wrong, but my thesis is as the weather gets colder in the northern part of the US and into Canada, then the price of natural gas, you know, will respond to supply and demand. The demand will go up because people are going to be heating their homes and office buildings. And so I think that will put a bottom. Now the counter argument to that is we're going into a recession, and I think that the argument for gasoline you could make for a recession, because if we have large amount of layoffs, then people won't be driving as much, and so you have less gasoline consumption. Will people stop heating their homes if they lose their job? Well, probably, maybe they'll lower the temperature, put on a sweater, but I don't think they'll stop heating their homes. So I think that natural gas has more upside than oil in that regard. And the AI play with all these data centers, you see how the price of uranium, coal, what else? Some of the utilities have gone to the moon because it's a play on energy. All they have to do is say, I just heard today, somebody said, Caterpillar, the company that makes heavy equipment, that's now an AI play. And that's why Caterpillar's going to the moon. And they did that with utilities a year or two ago. I remember, what was it? Constellation, I think, jumped. I mean, you see a utility should be, historically utilities move, single digits in a year. And I think that thing was responding like a tech stock. So this is where you really have to be nimble. So as far as natural gas, I'm playing it out till, I'm doing the weekly expirations every week out to November 14th. Because November 21st is a monthly expiration, and so I do have some trades on that. But so as an example, you can do one of two ways, and this is why it's so important to learn how to trade options, because you can trade these things for income, and you can choose to limit your risk anywhere you want on that. Doesn't mean you won't lose or you can't lose. Hold on, I got a helicopter coming in. Okay, so let me just give you just two very simple examples. If you trade options, you can go out to November whatever, 7th, 14th, and you can do a 50-cent strike spread. So I think natural gas dropped down to $11.70 today, and it bounced back up closer to $12. So I was selling more put spreads when it dropped, because this is why you have charts, right? Or this is why you have support lines and resistance lines. You have to trust them based on your experience level and your comfort level with these things. And if it breaks, then you go down to the next line, and the next line will show you where the new resistance or support is. You don't get afraid of these things. And with natural gas, worst case scenario, go into anytime you sell puts, you want to say, okay, worst case scenario, I'm going to take possession of these shares. So you just want to have the cash to be able to take these on. And so with this, that's why for even a small account can handle this, where if you went in and you sold, I'm just going to use this, you can adjust this as needed. But let's say for this example, you choose November 7th, you sell a $12 put and you buy an $11.50 put. Okay, so that's a 50-cent wide spread. 12 minus 11.5 is 50 cents. So the total risk on that is 50 cents, which equals $50, right? Okay, so, and what you're doing is you're collecting the premium, and you want to collect at least half. When things are really, when the IV is really pumping, you can sometimes collect 40 to 45 cents out of the 50 cents and put it in your pocket. And so in those examples, if the price of natural gas never drops below your strike price, you keep that 45 cents. And then if, let's say, okay, so in that example of the 12 and 11 and a half, let's say that natural gas closes on the November 7th at $12.01. I keep, and let's say I did it for 25 cents. So I said I'll take half the credit. So I collected 25 cents on that 50-cent spread. That's the minimum that I will do it for, me personally. Depending on how long. I mean, if it's 1 week, then maybe I'd do it for 25 cents because you're only waiting 1 week. And if you divide 25 cents into $1,200, I think that's 1.25%. So you're risking, your basic, your rough ROI is 1.25 cents in 1 week or 1 month, depending on what it was. Even if it's 1 month, okay, you're earning 1.25% a month, which annualized is what, 14%? So if you're using cash that's collecting 4% in your account and you annualize another 14%, all of a sudden your returns are 18% if you did that all the time. That's probably gonna handle inflationary pressures. Okay, and this is why trading options, I think, is so important. It doesn't mean you're gambling wildly, you're making educated bets. Okay, so in case number one, the options expire and you keep the money. Case number two, if it drops in between the price, let's say it goes to $11.75 on the date of expiration, well, you have a choice. You can take possession of the shares, okay, at $12, and when you close it out, you'll probably collect a credit. And so your cost basis would probably be, say, we'll just say $11 to $11.25, in that range. So your cost of basis would be we'll say $11.50 and the price will be $11.75. So you're already up on the trade. So you can basically, it depends on your mind frame. If your thesis is that natural gas has the potential to go higher, then you don't mind taking possession of shares at $11.25. If you look at the chart, it's an excellent entry price. Now, if natural gas goes to $3, then it's not such a great entry price, but you worry about that later. And I don't think that's going to happen, but nobody thought that USO would go to 0. So that's another story for another day. So that's one type of trade. If you're more aggressive, the other type of trade I do, I alternate the expirations. So I do that type of trade on, I think, the odd weeks, and on the even weeks, what I do is I buy the $12 put and I sell 2 of the 11.5 puts, okay? And why would you want to do that? Well, like I said, I think the entry price is pretty good. And I think I've done some 11.5 and 11s as well, so that if it does drop, I mean, I'm really at an excellent entry price based on what the chart says now. So again, if I bought the $12 and sold 2 of the 11.5s, then what would happen is if the price drops to 11.7 at expiration, the put that I bought would be in the money, so I'd be collecting money on that. I'd collect approximately 25, 30 cents, whatever it is, which is $30. And the other options would expire worthless. The options that I basically sold and collected credit. And again, I do these trades, all of these trades, you collect a credit. Always collect a credit. That means they pay you to do the trade. And why is that important? Well, because if the trade, most likely these trades are going to expire worthless. I think 95% of all options expire worthless. So if they expire worthless, you keep the money. So if I'm collecting $25 here, $50 here, $25, is it a lot of money? No, it's not a lot of money. You can arrange it in such a way that it could be a lot of money, but these are, if you do these types of trades, you do a couple contracts every week, and you're collecting $50 a week on the two trades. Well, that's one piece of a puzzle that adds income. So those are the two different trades. I'll write it as well in the comments. And if the price of natural gas drops, okay, below your hedge strike price, well, the beauty of the first option where you're selling a 12 and buying an 11.5, the beauty of that is that, let's say it goes down to $10.50 at the date of expiration. The beauty of that is because I have a sell and a buy, it basically rolls down a 1-to-1. So as the loss on the put you sold increases, the gain on the bottom hedge increases. And so when it comes to the date of expiration, if the price of natural gas of UNG is 10.5, you may find that your entry price might be 10.7. Okay? So you're still at an excellent entry price because of the way you structured that option. The other way, your more aggressive way, well, too bad, so sad. It's the benefit of that is, let's say I bought a 12 and sold 11.5s. The price goes to 10.5 on date of expiration. That's going to basically put $50 in my pocket, because the 12 to 11.5, that's going to give me a credit of 50 cents. So it's going to give me an entry point of $11 when the price is 10.5. Now, you can also, what you can do is, because you sold two legs, what you can do is you can let one leg expire or get exercised with the 12, put 50 cents, $50 in your pocket, and then you can roll the other one if you don't want to take the shares. And those are two. So there are always options. And when you roll it, you roll it when you get, if you're not getting a credit, then I usually don't roll it. So, and you can do the same strategy with any ticker. And the reason I like UNG and other tickers that have 50 cent or $1 increments is because it limits your total exposure. Now, it means it limits your potential gains, but this is where what I tell people who I give advice to on this stuff is, don't try to cover 20 tickers. Get one or two tickers or three tickers, but one or two that you just follow the charts every day. You follow the charts every day, and you will start to get a vibe, a feel for how these things move at different times of year, different times of week, on different types of news, and it will become more comfortable. And with that comfort level, you will realize that if you are exercised and you have to buy 100 shares for $1,050, you're not scared. Okay? You're probably excited, because this is a very famous strategy called the wheel strategy, where it's a modified wheel, where what you're doing is, the days of buy and hold for a lot of stuff, it's, in my opinion, in many cases, there's more risk. And so the nice thing about this strategy is, if you're going to have shares, if you're going to be holding anything, you want to be making money on it. And by selling premium against the shares you own, they pay you. And if you pick out of the money strikes, then you will earn premium for just holding those shares. And so it just, again, even if it's just a couple points, that's points that are going into your pocket that you wouldn't have collected otherwise. And if there's news that you didn't expect and the price goes up 50% and you have to sell it for a lot lower price, that's happened to me more times than I can count. Yeah, it stinks, but it's the overall strategy. The overall strategy was I still sold that for X amount of percent. Yes, I left money on the table, but that's something that you're going to have to accept. If you're going to trade, you're going to leave money on the table one or two ways. You're going to either lose money or you're going to sell something and it's going to rip without you. And me personally, I don't like losing money in any way, but if I'm going to leave money on the table, it's just something that for me, and this is a personal decision you have to make, for me, I want to make money and not just have something. And so if it means that it's happened to me with the miners, I sold a bunch of my miners and I did not expect the miners to double their price in like a month, 6 weeks. And so I'm sitting there watching them leave the train station without me. And I can talk about that as well, because I've been on both sides of the fence on that one. And if you chase it, sometimes it works, sometimes it doesn't. And this is where you have to decide how much money you're willing to risk and how much. But UNG, look at it. You don't feel comfortable, don't do it. But the worst case scenario, if you took that first trade, if you sold a $12 put November 7th and you bought an $11.50 put and you collected $25, okay, the worst case scenario for you is you'll lose 25 bucks. That's the worst. You've collected 25. So if it goes completely in the wrong direction and you don't want to hold shares, you can basically get out of the trade and lose no more than $25, not including the commissions, whatever you pay for commissions. And so that's a 1-to-1. That's a 1-to-1. Not the best ratio, but the reason I like that structure is because a 1-to-1, or I should say the selling one and buying one, it allows it to roll, and that's why I like it. Because unfortunately, just because I have a thesis on what I think is going to happen, where it's going to go, doesn't mean I'm going to be right. And so I always go into it thinking, if I'm wrong, what is my downside? What is my risk? And me personally, these days, I tend to go with lower risk rather than trying to hit for a home run. And if I do try to hit for a home run, I make sure that I know what my downside risk is. And if I'm comfortable risking $500 to make 10 grand, then I'm going into that trade knowing that. But I'm not going into a trade saying, okay, I have no idea what my risk is and I have no idea what my upside is. So the upside on the natural gas trade is you're gonna collect premium. Most likely, probably an 80% chance, you're gonna collect premium, and the trades are gonna expire. And there's probably a 15% chance, and this is just my guesstimates, that you'll get exercised. And if you take possession of shares, you can then sell a covered call on it, earn premium on that, and then lose the shares at whatever, and then sell those shares at whatever price that you want to sell them for. And so you could make money on both sides of the trade and turn a $25 or $50 profit into a $100 profit. And okay, I got to stop talking. My voice is going. So So, beautiful day. So there are some other trades that that are a little bit riskier that I can get into, and they're riskier because, you know, well, if anybody's interested, I'll explain these other trades as well. But for now, I'll just give out that one. Peace.